Hello my dear students, welcome everybody. Now today we are going to start one more accounting standard in our financial accounting paper, which is Accounting Standard 22, Accounting for Taxes on Income. So what is the standard, sir? Accounting for taxes on income. So the name of the standard is Accounting for Taxes on Income, Accounting Standard 22. Accounting Standard 22 is accounting for taxes on income. Very interesting standard, sir. But see, you should have income tax knowledge also. To understand this standard perfectly, we should have Income Tax Act provisions knowledge also required, because we are talking about what? Taxes on income. We are talking about taxes on income. So generally on income, which taxes will be levied? Income tax. We know that income tax is levied on incomes. It's a direct tax which is directly levied on income. Now first of all, why this standard was introduced? What is the reason for this standard? If you understand that, then it will be very easy. You can easily understand the concept of this standard, or you can understand very easily the provisions of this standard once you know the purpose why this standard has been brought. Okay. Now first of all, let me explain you the basics of this standard. See, there are two concepts. One is accounting income. Accounting income. Accounting income and taxable income. Accounting income, taxable income. Sir, what is this accounting income? What is this taxable income? See, every business entity, we know that they are going to prepare financial statements every year. Every business entity will prepare financial statements, definitely, you know that. So, what are the financial statements components? Balance sheet, P&L. Now, through P&L account, we will ascertain what? Net profit, right? That is called accounting income. So, this accounting income is nothing but profit and loss account. So, every year we prepare P&L account and we ascertain the profit of the business of that year. Now, you tell me, on what basis you prepare this P&L account? What is the source? Which guidelines you follow to prepare this P&L account? See, to prepare this P&L account, we follow accounting standards. Accounting standards we follow, and Companies Act Schedule 3 we follow. Companies Act Schedule 3 we follow, and some generally accepted accounting principles we follow. GAAPs we follow. We know that, see, every year we maintain books of accounts. Now those books of accounts we will prepare we will prepare financial statements based on those books of accounts. Now we consider accounting standards, the provisions of the Companies Act, and generally accepted accounting principles. By considering all these things, we prepare P&L account. And we will arrive at one net profit. Okay. So, this is accounting income. P&L account what we prepare. Now the question is, whatever profit you arrived by preparing P&L account, is tax will be paid on that profit? Is tax is paid on that profit? For example, you prepared the P&L account, sir. Now you got the net profit. Suppose you got the net profit of 100 lakhs. Now, can I pay tax on this 100 lakhs? So suppose, for example, this is a company, tax rate applicable is 30%. So 100 lakhs into 30%. So 30 lakhs will be the tax liability. Is this correct? No, this is not correct. Why? Because in India we have separate act called Income Tax Act. Now that act prescribes which expenses are allowed, which expenses are not allowed, which deductions will be given, up to what limit they will be given, which exemptions will be given for which businesses. Now Income Tax Act will have its own provisions and rules. Whenever you want to pay tax to the government, you need to follow the provisions of Income Tax Act. Right? But when you are preparing profit and loss account, you are following Companies Act. So there is a difference in provisions, definitely by following accounting standards, Companies Act and Income Tax Act. So see here, for example, my net profit as per P&L account is 100 lakhs. Now can I pay tax directly on this 100 lakhs? Answer is no. Government will not accept. Sir, why they will not accept, sir? Because they have brought one act called Income Tax Act. Now by following that act only, you need to compute your taxable income. So therefore, see here, what is taxable income? Taxable income means the income based on which you need to pay tax to the government. And sir, how I prepare this taxable income? By following the provisions of Income Tax Act. So what is taxable income, sir? Taxable income is the income which is arrived. See, this is arrived by provisions of Income Tax Act, by provisions of Income Tax Act. Now by following the provisions of Income Tax Act, we got this taxable income. Okay. Now the question is, see, sir, you are preparing P&L account by following the provisions of Companies Act, accounting standard. By following those rules, you are preparing P&L account, right? But whatever profit you arrived by preparing P&L account, that is not the base to pay tax in India. The tax will be paid by computing taxable income. How to compute taxable income? We know that in Income Tax Act there are different provisions. By applying those provisions, for example, see, income from house property, then PCBP, then capital gains tax, then capital gains, then income from other sources, then gross total income minus chapter 6A deductions, then you will get total income. On that you apply tax. Whenever you are applying tax, so general rates, normal rates, special rates, like that you apply and you ascertain the tax liability, right? Now see, and moreover in Income Tax Act, we have special deductions, and sometimes there is a deferment of benefits. Deferment of benefits. Suppose, for example, Income Tax Act, suppose any preliminary expenses incurred. So Income Tax Act says these preliminary expenses we will allow over a period of 5 years. I think in section 35D, one section is there in PCBP. That section says that preliminary expenses will be amortized over a period of 5 years. That means even though there is a preliminary expenses, you debit to P&L account directly. But in income tax, that will not be allowed this year. That will be allowed over a period of 5 years. That means only 1/5 of preliminary expenses is allowed this year. Remaining 4/5, the remaining 4 parts will be allowed in the future years, because of the provisions of Income Tax Act. And one more thing, suppose see depreciation. See, depreciation is the best example, sir. Sir, when you prepare P&L account, you calculate depreciation by following the provisions of Companies Act. Companies Act schedules, you follow the rates which is given in the Companies Act, and you prepare, you arrive at the depreciation. Whether that depreciation is the depreciation which is allowed as per the Income Tax Act? No, sir. In income tax, we know section 32. So there is separate rates of depreciation given. For example, building 10%, plant and machinery 15%, some plant and machinery is 40%, like that they have given. Now by following those rates, we calculate depreciation. Now the depreciation is allowed as per Income Tax Act when you are calculating taxable income. But when you prepare P&L account, you follow Companies Act. And some more thing, for example, section 35 AD. Suppose you are engaged in specified business, 100% of the capital expenditure is allowed in the year of incurrence of expenditure. For example, you are in the cold chain setup business, or your agriculture, for example, warehousing facilities, or you are running a hospital, or maybe hotels of 2-star and above category. Now you are providing infrastructure facility business as per section 35 AD. Whatever the expenditure you incurred, capital expenditure, 100% is allowed in the year itself as per Income Tax Act. But in P&L account, is it allowed? No. So the point to understand is, whenever we want to pay tax, whatever the profit we arrived from P&L account, that profit is not the base to calculate tax. We need to calculate taxable income, total income, as per the Income Tax Act by following the provisions of Income Tax Act. And then we need to ascertain the tax liability. So fundamentally, there is a difference. What is the difference? When you when you want to calculate taxable income, you need to follow the provisions of Income Tax Act. But when you want to ascertain the profit of the business, so you need to follow the Companies Act. Of course, see, this Income Tax Act we follow purely for what? Purely for income tax calculation purpose only. Okay. So now the question is, see, listen. See, first I am explaining the difference between accounting income and taxable income. So now you understood. Okay. Every business entity, they will prepare financial statements, P&L account, accounting income, net profit, nothing but. And when they prepare P&L account, they follow what? Generally accepted principles like accrual concept, consistency concept, contingency concept, like that. Some concepts are there na, accrual concept, like prudence concept, substance over form. All these principles we follow, and we will prepare the P&L account, and we arrive at the net profit. And we follow accounting standards, and we follow schedule 3. By following all these provisions, we prepare P&L account. But when and by preparing P&L account, we ascertain one profit, net profit. Now, can I pay tax on that net profit? Answer is no. Because as far as the tax is concerned, in India, we have separate act called Income Tax Act. Now, that act is providing some benefits, some exemptions, some deductions. So that act is providing some exemptions, benefits, deferments, like that. So therefore, you need to follow that act to arrive at the taxable income. So taxable income is arrived by following the provisions of Income Tax Act. Now obviously, what happens if you follow different different rules and regulations? Definitely there will be differences will arise. Now suppose, see, I will tell you. See here, suppose we got net profit. Of course, incomes minus expenses, all those things we done. We got a net profit of 100 lakhs. Okay. Now see, I want to pay tax. So now I will ascertain the taxable income. Now suppose by following the provisions of Income Tax Act, we ascertain taxable income. Now the taxable income is, for example, see here, taxable income is, suppose 60 lakhs only came. Sir, important sir, my net profit is 100 lakhs, my taxable income is 60 lakhs. Sir, there is a difference. Sir, is differences will come? Yes. Why? Because see, you are following Income Tax Act provisions na, to pay tax. To arrive this taxable income, you are following this Income Tax Act provisions. You are not following Companies Act provisions. But whereas for preparation of P&L account, you are following Companies Act provisions, accounting standards, generally accepted accounting principles. But Income Tax Act won't follow all those things. So don't ask Income Tax Act, follow accounting standards. See, in income tax we have separate standard, ICDS. Of course, I am not deviating from the subject. See, Income Tax Act entirely different. For example, see, one best example I will tell you. See, in accounts, normal accounts, we follow accrual concept. Na? Accrual concept. Whenever any expenses incurred, we will recognize, or we follow prudence concept. See, prudence. In accounts, we follow the concept of prudence. Whenever any losses are there, we will anticipate and we will recognize in P&L account. But Income Tax Act won't allow recognition of losses on prudence basis. They say mark to market losses will be recognized only when they actually realized, only when they actually settled, then you have to recognize. Sir, how we know all these things? See, when you study Income Tax Act, you know all these things. It is there in your syllabus now. So that's why, see, for this standard, you need to understand, you have little bit understanding of Income Tax Act also. So my advice is, before coming to Accounting Standard 22, at least read PCBP chapter once. Profits and gains of business or profession, one chapter is there. That chapter you read at least once. Or at least, suppose sir, we don't know anything in Income Tax Act, then please don't read this standard. Only after having some knowledge of Income Tax Act, come to this standard. Because see, this standard is nothing but the comparison between accounting and taxes. So therefore, it is inevitable. You should have the basic understanding of Income Tax Act. Of course, I will try to explain to the extent possible. But in spite of that, if you want to get better grip of this standard, you should have a little bit knowledge about Income Tax Act also. Of course, I am confident that being a professional student, income tax is one of the core subjects. So I think all you have some knowledge of Income Tax Act. Okay. And at least the knowledge which help us to understand the things properly. Basic knowledge. We are not like, see, we are not comparing accounting income with some physics or chemistry. So Income Tax Act, we know, every student, professional student, CA, CMA students know this. Okay. Now see, the point is, I ascertain the taxable income, 60 lakhs came. Net profit, 100 lakhs came. So there is a difference of 40 lakhs. See, there is a difference of how much? 40 lakhs. Sir, why differences arises, sir? See, difference arises because of Income Tax Act. Because of provisions of Income Tax Act. And accounting provisions. I told you, for example, see, interest. See, in accounts, generally, when we incur interest, we will debit to P&L account. But the PCBP chapter, Income Tax Act says, section 43B, only when you pay the interest on or before due date of filing return of income, it is allowed. That means there we will allow interest on payment basis. Here we allow interest on due basis also. So one difference came. Like the depreciation I told. For example, in accounts we follow depreciation by following the rates which is prescribed in the Companies Act. But in income tax there are separate rates. Separate way of calculating depreciation. No, definitely the differences will come. And one more thing. So for example, some exemptions, some deductions. For example, see, 35 AD, specified business. Suppose when you are doing any specified kind of business, 100% of the capital expenditure is allowed as per Income Tax Act. But this Generally in accounts, we don't allow capital expenditure. Any capital expenditure we will recognize as an asset. For example, see section 35 AD says whenever you purchase any capital expenditure, for example, we purchased one plant and machinery. The cost is 50 lakhs. Now see, this 50 lakhs we don't debit to P&L account. As far as the accounts is concerned, this 50 lakhs we will show it in the balance sheet. We don't allow this as a loss, as an expenditure. But Income Tax Act allow this 50 lakhs as what? As a deduction. So therefore definitely differences will come when you compare accounting income and taxable income. Because there are separate set of provisions in the Income Tax Act. And similarly, one more example I told, that preliminary expenses. See, preliminary expenses, suppose we incurred 10 lakhs. We will directly debit to P&L account. But Income Tax Act says, as per section 35D, we don't allow this 10 lakhs at a time. We will allow it over a period of 5 years. That means every year 2 lakhs only we will allow. That means, see, in P&L you debited 10 lakhs, but as far as the income tax, when you are arriving taxable income, you are considering only 2 lakhs deduction. Remaining 8 lakhs, they will be allowed over the next 4 years. That means there is a difference in this year. So therefore, the point to understand is, whatever expenses, whatever the losses, whatever the provisions you are creating, in accounts no problem. We follow accrual concept, prudence concept, we will anticipate everything. Accrual concept, we recognize all expenses, any losses we anticipate, we recognize, any provision we create, we recognize, everything we will recognize. But Income Tax Act says, go to hell, we don't allow all these things. See, simple funda is, accounting income always, Companies Act, Accounting Standard Schedule 3, see, all these things, accounting point of view, they always want to show less profits, they want to reduce your income. But Income Tax Act says, income tax provisions are framed in such a manner that they always want your taxable income is more, because government will get more taxes. Of course, may not be true in all the cases, but basic intention behind it. Okay, anyways. Now see, the difference is net profit 100 lakhs, taxable income is 60 lakhs. So there is a difference of 40 lakhs. Now this difference arises because of so many reasons, because of provisions of Income Tax Act. Okay, sir, okay, difference arises. Then see, what is your taxable income? 60 lakhs. Now calculate the tax liability. Suppose tax liability. Suppose you are a company. In case of a company, what is the income tax liability, sir? 30% tax rate. Of course, in the year 2021-22, if your turnover is less than 400 and less than that, then 25% doesn't matter. Suppose 60 lakhs into 30%. So 60 lakhs into 30%. So it will be 18 lakhs. 18 lakhs is the tax liability. Right? 60 into 30. 18 lakhs. So that means, what is your current year tax liability? 18 lakhs. This is my current year tax liability. This is what I need to pay to the government. Income Tax Act. 18 lakhs. And how I got this 18 lakhs, sir? By ascertaining taxable income by following the provisions of Income Tax Act. I got this liability. Now, listen. 18 lakhs is my current year tax liability, right? Now come to P&L account. See, from net profit, I need to show the tax expense. Tax expense. Because see, this is net profit before tax. Right? Before tax. We will show net profit before tax. PAT, profit after tax. PBT, profit before tax. See, this 100 lakhs is what? PBT, profit before tax, net profit before tax. Now tax expense. So what is my current tax? Current tax. See, current tax means the tax liability of the current year, which you ascertained by following the provisions of Income Tax Act. Now, by following the provisions of Income Tax Act, what is your current tax? 18 lakhs. Now, the main standard begins here. See, till here, absolutely fine. Now see. Sir, what is the problem here? Can anybody tell me, or can anybody think what is the problem here? See, simple. We got the net profit from P&L account 100 lakhs and taxable income 60 lakhs. We prepared as per the provisions of Income Tax Act and 30% tax liability. So we got tax liability of 18 lakhs. I am not adding health and secondary higher education says surcharge. I am not bothered about all those things. Direct flat rate I applied. Okay. For a while, ignore all other things. Okay. Now see, this is my current year tax liability. Now this 18 lakhs I need to present it in the P&L account as tax expense. Current tax 18 lakhs. Now is there any problem here? Now this is the thing they are actually following. Is there any problem here? Anything technically wrong here? Any technically wrong? Why this standard has been brought? Everything is fine, sir. Why they are bringing this standard? See, there is one big problem here. There is one conceptual thing is there. What is that? See here. What is your net profit as per P&L account? 100 lakhs. Now you are showing your tax liability as 18 lakhs. And you know that this 18 lakhs came from taxable income. Now you are saying that I earned a profit of 100 lakhs, but you are paying tax of 18 lakhs. Sir, what I do, because they brought one act, income tax act. Suppose if this act is not there, I will pay tax on 100 lakhs only. 100 into 30%. Government will get 30 lakhs tax. See, we know. Suppose for example, if there is no income tax act, what people do? They won't show this 100 lakhs. They will make it 10 lakhs. By booking all fake bills, fake expenditure, claiming all unnecessary things, all kind of provisions they will make. So people these days very smart, so whenever there is a loophole, in spite of, there are so many provisions in the income tax act, in spite of these provisions, these many number of provisions, still people are doing different things, and still they are finding loopholes in the act and taking advantage of it. And imagine if the income tax is not there, government will not get anything. Entire revenue will be gone. Okay. Now the question is, your net profit, your current tax. See, these two are not matching. Sir, is they need to match? See, suppose, imagine, you said you earned 100 rupees. 100 lakhs you earned. Now when you earn 100 lakhs, on that 30% if I apply, 30 lakhs will be your tax liability. But you are showing 18 lakhs only my tax liability. That means, whatever the accounting income, profits you are earning are not matching with the taxes of the current year. Okay, now little bit serious, the standard. So, I am earning profits, I am saying 100 lakhs is my net profit, but I pay tax as per taxable income. Now, it came only 18 lakhs, now I am showing it. Now, the problem is, they are not matching with each other. What is matching? See, there is an income, there should be a corresponding matching of taxes. We got matching concept now, incomes versus cost, expenses. Similarly here, my net profit before tax is 100 lakhs and my tax expenses should be what? 30%. So it should be 30 lakhs. But I am showing only 18 lakhs. 12 lakh shortage. Now why this situation happened? Think about it. Is it intentionally I am doing? No. Because of Income Tax Act, this situation came. Because in income tax we follow different provisions to ascertain the tax liability, to ascertain the taxable income, this situation came. Oh. Sir, that means suppose here we got only 60 lakhs, not 100 lakhs. Here we got 100 lakhs. Now that means there is a difference between this accounting income and taxable income. Okay, sir. Now why these differences came? There could be many reasons. Now standard says, see, because of this difference, your accounting income, your net profits, your incomes are not matching with taxes. So what you do is identify the reasons for this difference. Now if this difference is a temporary timing difference, then do one thing. You also recognize one concept, one item called deferred tax. By using the concept of deferred tax, you match the accounting income with tax expenses. Once again I am telling, sir, So there is a accounting income, there is a taxable income. Here in our example, 100 lakhs is accounting income, 60 lakhs is taxable income. So there is a difference of 40 lakhs. Now say the reasons for this difference. Now if these differences are temporary timing differences, then what you can do is, these are anyway temporary differences. For this 40 lakhs, you book the deferred tax in the books so that there will be matching. Suppose see, here 100 lakhs is my net profit. See, deferred tax. If I say deferred tax, suppose 40 lakhs into 30%, because the difference is 40 lakhs na? Into 30%. So it will be 12 lakhs. Now see, because of this deferred tax, what is my tax expenses now? 18 plus 12, it will be 30 lakhs, which is exactly matching with this. 100 lakhs into 30%, now also tax expenses is 30 lakhs. Now how tax expenses has become 30 lakhs? Because they introduced a concept called deferred tax. Why they introduced the concept of deferred tax? Because we know there is a difference between accounting and taxable income, and this difference is only a temporary timing difference which is going to be reversed in the future. Therefore you anticipate that, and correspondingly you recognize one item called deferred tax. This deferred tax can be deferred tax income, deferred tax asset or deferred tax liability. Okay, sir, here the most important thing, sir, listen. The most important thing is, what is this difference? See, I am saying that there is a difference, na? There is a difference between accounting income and taxable income. Why this difference arises? I said timing difference. Sir, what is timing difference? See, standard says timing difference means the difference between accounting and income tax. But this difference is going to reverse in future. That means this difference is only a timing difference. In future it is going to reverse. Oh, that means this year it seems difference, but coming years it is going to reverse. So therefore the difference which you are saying now, it is going to reverse in future. Therefore why can't you anticipate? Why can't you anticipate the reversal, the future difference which is arises now, which is going to reverse in future? Why can't you anticipate and recognize that as deferred tax? Because of that only they are not matching. See, because of that reason only they are not matching. Of course, see, there are some permanent differences. If the difference is permanent, no need to recognize deferred tax. So deferred tax concept will be recognized only when there is a timing difference between accounting income and taxable income. I will tell you best example for timing difference. Wait. See, for example, I will tell you, listen to me carefully. What is timing difference? See, suppose, sir, my net profit before interest, and tax is 100 lakhs. Okay. Now my interest expenses 20 lakhs. Now how much? 80 lakhs. Right? This is my net profit before tax. See, this is as per accounts. This is as per P&L account. Now coming to income tax, taxable income. Now tell me, what is my net profit? I will start with net profit before interest and tax. How much? 100 lakhs. Now this interest of 20 lakhs, tell me, in P&L accounts, whichever year we incur any income tax, interest, we will directly debit to P&L account. Now we will allow it. But in income tax, when interest expenses is allowed, for example, interest on loan, this is interest on loan, sir. Suppose we have taken a loan from a bank or a financial institution. On that loan we need to pay interest. Now current year interest expenses is 20 lakhs. Now you debit to P&L account, because expenses incurred we write to P&L account. No, we are not bothered. Now tell me, in income tax, whether this interest on loan you have not yet paid, only incurred, will it be allowed? Answer is no. See, because read section 43B, it says interest expenses on loans will be allowed only when you pay. I think on or before due date for filing return of income, when you pay, it is allowed. Otherwise it is not allowed. Suppose, for example, you have not yet paid, therefore this 20 lakhs is not allowed. That means whatever your net profit before in interest and tax, this is your taxable income. 100 lakhs is your taxable income. But as far as the accounts, what is the income? 80 lakhs. See this, the difference is because of what? That interest 20 lakhs. That difference is because of 20 lakhs. That 20 lakhs you debited to P&L account, but it is not allowed as per Income Tax Act. Why? Because as per the Income Tax Act, it is allowed on payment basis. But in P&L account, we take it on accrual basis. As and when it is incurred, we will recognize. Now, because of this, there is a difference. And we know as per the Income Tax Act, whichever year you pay that, it will be allowed. Suppose, for example, this year I have not paid the interest on or before due date filing of return of income. Suppose on or after due date filing of return of income I paid. That means it is allowed in the next year. It may not allowed in the current year. It is allowed as per the Income Tax Act in the next year. That means this year there is a difference of 20 lakhs between accounting income and taxable income. 20 lakhs difference is there. Now this difference is going to reverse in the next year. How? Because next year you paid as per the Income Tax Act, it is allowed. That means next year my taxable income is reduced by 20 lakhs. But accounting income already this year you given the benefit, you debited to P&L account. This year accounting income, next year accounting income will not deducted by 20 lakhs because already 20 lakhs is debited to P&L account. But as far as the taxable income is concerned, it is deducted by 20 lakhs. Because it is not allowed as deduction this year, it will be allowed as deduction in the paid year, next year. So therefore, because of Income Tax Act, interest is allowed on paid basis, not on due basis. But in P&L account, you recognized on due basis. So this year there is a difference between accounting income and taxable income. What is the difference? 20 lakhs. Now you know this difference is going to reverse in coming years. How? When you pay, it is allowed as per the Income Tax Act. That means this year there is a difference. So this difference is called what? Timing difference. Why it is timing difference? Because in the year of payment, it is allowed. That means that year, coming year, in whichever year you paid the interest, your taxable income is less than accounting income. That means this year your accounting income is less than taxable income. Your taxable income is more. But in the coming year, the year which you paid the interest, that year, to the extent of interest you paid, your tax liability, your taxable income is less than accounting income. That means whatever the difference arises this year, it is reversed in the coming year. That's why this is called timing difference. So they say you identify the differences. If these differences are timing differences, you know that these differences are going to reverse in the coming years. Therefore, accordingly, you book deferred tax asset or liability. Because that is the main reason why. See, the difference between accounting income and taxable income, the main reason why the taxes are not matching with the net profit, accounting income. So in our example, my accounting income is 100 lakhs. But my tax expenses is 18 lakhs. So they are not matching. Why they are not matching? I verified my accounting income 100 lakhs, but my taxable income is only 60 lakhs. So there is difference of 40 lakhs. Now this difference is because of which reasons? Is these reasons are timing, temporary differences? Now if they are temporary differences, you anticipate and recognize deferred tax. So that there will be matching of accounting income and its taxes. Now you anticipate this deferred tax now. In whichever year it is reverses, you cancel it, reverse this. Okay, sir, suppose for example, if the difference is permanent difference, ignore it, don't recognize deferred tax. For example, I will tell you one example for this. See, suppose you paid penalty, sir. Suppose net profit 100 lakhs. Suppose before penalty, this is net profit before penalty, suppose 100 lakhs as per P&L account. Now we paid penalty for violation of law. See, for violation of law we paid penalty 10 lakhs. So we debit to P&L account. So what is my net profit? 90 lakhs as far as the P&L account is concerned. Penalty is debited to P&L account. Whatever penalties, prosecutions, fines, whatever we pay, those are our expenses or losses. We debit to P&L account now. So this is accounting income, 90 lakhs. But now come to Income Tax Act. Your net profit before penalty 100 lakhs. Now you tell me, as far the income tax is concerned, is penalties allowed as deduction? any penalty paid for violation of law, is it allowed as per the Income Tax Act? No, they are not allowed. Section 37. They are not allowed. Any penalties you paid, they are not allowed. That means, see, there is a difference. Your taxable income is 100 lakhs. Accounting income is 90 lakhs. So the difference is how much? 10 lakhs. Now tell me, is this 10 lakhs is going to reverse in the coming years? No, because this 10 lakhs is not allowed as deduction in any year. So that means there is a difference between accounting income and taxable income. Your accounting income is 90 lakhs only. Your taxable income is 100 lakhs. So there is a difference of 10 lakhs. Now can I recognize deferred tax on these 10 lakhs? Answer is no. Because only timing differences will give you deferred taxes. That's why see, they put the appropriate word, deferred tax. Differing. Because see, they know that this tax is differing for the future. Because it is not that there is a difference. This difference is going to reverse in the coming years. That's why we are booking deferred tax. Okay. Now see. So slowly I am going, sir. First, once again I am recollecting what I am discussing. First thing is, there is a accounting income, there is a taxable income. Two things are there. Accounting, tax. Okay. Accounting income, taxable income. Now accounting income is nothing but P&L account. You prepare P&L account. What is the basis for preparation of P&L account? Accounting standards, Schedule 3, Companies Act provisions, generally accepted accounting principles. By following all these things, you prepare P&L account. And you will get what? Net profit. And on the other hand, can you take this net profit from P&L account and pay tax on this? No. You have to ascertain taxable income by following the provisions of Income Tax Act. So by following the provisions of Income Tax Act, we need to find out taxable income. On this taxable income, we need to pay tax to the government. Suppose on taxable income, whatever the tax came, that tax if I show in the P&L account, so there may be differences. There should not be any matching between my accounting income and my taxes. Now why they are not matching? Because the reason that the accounting income and taxable income both may come different because of the provisions of Income Tax Act. Now identify the reason for those differences. If the reason is temporary reason, timing reason, now only because of the time these two are not matching. So you match it by anticipating the future. Suppose for example accounting income 100 lakhs, taxable income is 60 lakhs. So there is a 40 lakhs difference. Now you identify this 40 lakhs is a temporary difference. It is anyway going to be allowed or it is going to be reversed in the coming years. Now you anticipate and you match the accounting income with taxes by introducing a concept called deferred tax. By bringing a concept of deferred tax, you match the accounting income with tax expenses. Now, so the major challenge here is identifying the reason for difference. Is it timing difference or permanent difference? See, when we say the reason is timing difference, the reason is timing difference when the difference arises in the current year, but it is going to reverse in the coming years. That means, see, even Income Tax Act also allows the benefit, but they may differ the benefit. See, for example, depreciation. You take depreciation as per P&L account, as per Income Tax Act, both are ultimately same only, because whoever provide depreciation, the entire cost of the asset will be depreciated. Whether it is Income Tax Act or any Companies Act, ultimately we can provide depreciation up to the cost of the asset. So overall depreciation is same, but the difference is in amounts of the every year. So this is the classic example of what? Timing difference. So there is a difference in the current year, but in future, see, I will tell you, see here, listen. See, suppose for example, there is an asset. See, everybody please understand. There is a asset here. Suppose one plant and machinery is there. Now, first year, there are life of the asset is 5 years. For your understanding, I am telling. Suppose every year depreciation 10 lakhs. Every year depreciation is how much? 10 lakhs. Now tell me what is the total depreciation? 50 lakhs. Correct? See, this is as per the Companies Act. That means accounting income. Straight line method we followed, and every year we provide depreciation 10, 10, 10, 10, 10, 10. Okay. Now suppose for example, Income Tax Act. Suppose the first year depreciation, so total is same, total depreciation is same, but year wise differences, year wise depreciation if you see, suppose 7.5 first year, second year 6.375, third year 5.41875, fourth year suppose 4.61, and last year 26 lakhs depreciation. Or you can take imaginary figures also, sir, like this. See, I will tell you. For example, Income Tax Act, suppose the first year depreciation is 20 lakhs, second year depreciation 15 lakhs, third year depreciation 10 lakhs, suppose first year depreciation 15 lakhs, second year depreciation 10 lakhs, $25 lakhs first year suppose for example first year depreciation 12 lakhs, sir, I am taking 12 lakhs, second year depreciation 10 lakhs I am taking, third year depreciation 8 lakhs, fourth year depreciation, suppose fourth year depreciation 6 lakhs, and balance is provided in the last year 14 lakhs. Now the concept is, see, you see the difference. See, this is as per the Companies Act, total 50. This is as per income tax, total 50. That means ultimately depreciation is same overall, but the difference is in years. See, first year, what is the difference? 2 lakhs. Your Companies Act depreciation 10, but as per the Income Tax Act is 12 lakhs. So there is a difference of 2. Second year you come back, the difference is nil. Third year difference 2 lakhs. Fourth year difference 4 lakhs. Fifth year difference 4 lakhs. Right? So if you observe clearly, see, first year what is the difference between accounting income and taxable income? Your accounting income is 10 lakhs, depreciation provided. Here 12 lakhs we provided. So there is a difference of 2 lakhs. Right? Now second year there is no difference. Third year you see the difference. Third year if you see, your accounting 10, but your taxable income is only 8 lakhs. That means there is a reversal of 2 lakhs. And fourth year there is a difference of 6 lakhs, 4 lakhs. And next year it is reversed by 4 lakhs. So whatever the difference arises, that is going to reverse in the coming years. This is called what? Timing difference. Sir, why they are reversing? See, overall the amount is same. The reason is only temporary. One more example I can tell you is interest. I told here interest, 20 lakhs interest. Now this 20 lakhs interest, this year your accounting income is 80 lakhs. See, 80 lakhs. Your taxable income is 100 lakhs. So there is a difference of 20 lakhs. Your taxable income is more than accounting income. But we know in the year in which you pay, this 20 lakhs is going to be reduced from your taxable income. It is allowed. So therefore, the difference now is 20 lakhs, the timing difference, which is going to reverse in the coming years. You know this. So therefore, you anticipate the difference, identify the reason for difference, and for that, what will be the tax effect? So that is called deferred tax. So what is deferred tax? See, simple. Deferred tax is nothing but the tax effect of timing differences. Tax effect of what? Timing differences. Now the important thing is, sir, you said deferred tax. We need to recognize deferred tax. What is this deferred tax? Is this deferred tax asset or liability? See, simple. Listen. I said deferred tax. You have to recognize deferred tax. Deferred tax on tax effect of timing differences between accounting income and taxable income. Now this deferred tax can be what? Asset, deferred tax asset, or it can be deferred tax liability also. It can be an asset or it can be a liability, anything. Now see, when we say there is a deferred tax asset, when we say there is a liability, see, simple, sir. Simple, remember one simple principle. Save now, pay later, or pay now, save later. Save later. So you remember this golden rule to identify whether it is deferred tax asset or liability. Save now, pay later. If you pay now, you can save later. Suppose, what is this save now? See, today, if you are, not enjoying the benefit, tomorrow there will be saving of tax when it is allowed. Today, you enjoyed the benefit. Tomorrow, you can save. Save now, pay later. Today, you have not taken you enjoyed the benefit. See, through example, I will tell this. For example, sir, see here. My net profit is 100 and my depreciation as per the Companies Act is 50. So 50. Now as far as the income tax is concerned, my net profit is 100 and in income tax the depreciation is only 40. So 60. Now see, depreciation. How much depreciation is in P&L account? 50. How much depreciation as per Income Tax Act? 40. That means my taxable income is more than accounting income. That means I am paying now. I am paying tax on 60 lakhs. So there will be savings in future. What will be the savings? See, there is a difference of 10 lakhs now. I know that this is a timing difference. This 10 lakhs is going to reverse. So what will be the tax effect on this 10 lakhs? 3 lakhs. Now what is this? Is it an asset or liability? Asset. Pay now, save later. In future, the timing difference, the effect of timing difference is in the form of tax savings. Suppose in future, the effect of timing difference is results in tax liability. Then you recognize deferred tax liability. For example, sir, see, your net profit is 100 lakhs. And interest 20 allowed as per the P&L account. So it is 80 lakhs P&L account, accounting income. But when it comes to taxable income, net profit 100 lakhs, interest allowed, suppose it is not paid, so it is not allowed. So therefore your taxable income is 100 lakhs. So you pay tax on 100 lakhs. So what is the difference between accounting income and taxable income? 20. On this 20 lakhs, you are paying tax now because your taxable income is 100 lakhs. You are paying tax on this 100 lakhs. Why? See, the difference is 20 lakhs. That means this 20 lakhs interest you are paying now. You are paying the tax. Since you have paid the tax on 20 lakhs, we know this year there is a difference. But in the coming years, this difference is going to be reversed. Why? Because this 20 lakhs is allowed in the future years. So the difference between the accounting income and taxable income, today it results in tax liability. But tomorrow it is going to save some tax. How, sir? See, this 20 lakhs, suppose it is paid in the next year taxable income. When I arrive taxable income, interest will be deducted. That means my taxable income is reduced by 20 lakhs when compared with accounting income. Suppose accounting income next year again 20 lakhs will be allowed or no, because already it is allowed this year. So this 20 lakhs, there is a difference between accounting income and taxable income. Accounting income you taken, but taxable income you have not taken the benefit. And in the year of payment you will take the benefit. That means that today there is a difference, but this difference is going to be reversed by next year. Now, that this difference is only a timing difference which is going to reverse in future. Therefore, you try to match the gap between accounting income and taxable income by identifying the difference. If the difference is a timing difference, what will be the effect of tax? What is the effect on tax because of this difference? Now, you tell me, this 20 lakhs, whenever it is allowed in the next year, my taxable income is reduces. So, therefore, 20 lakhs into 30%. 6 lakhs. 6 lakhs, there will be what? Tax savings. Tax savings. So, this is called deferred tax asset. Asset means savings in tax. Asset means savings in tax. Similarly, there may be deferred tax liability also. Okay. Now, sir, entire concept I discussed till here. What I will do is, I will take one simple example, sir. Through that example, I will try to explain you the entire concept once again. Because this concept, it should, go to your mind, sir. Otherwise, it is very difficult. Okay. So, one example I will take and I will explain. With this example, I think whatever till now we discussed, I will consolidate everything through this example. Suppose there is an entity called X Limited, sir. Now, I am taking first the income tax computation, and then I will take P&L account also. Suppose this X Limited taxable income tax computation. And income tax computation means taxable income. Suppose I am taking 3 years. Suppose for example 24, 25, 25, 26, 26, 27. I am taking 3 years. And net profit before depreciation and tax given in the question. How much given? Net profit before tax and interest? 1 lakh given for all the years. Okay. Net profit before depreciation and tax. Now imagine, sir, this company has purchased one machinery, sir. The cost of the machinery is 30,000, and this machinery we purchased for scientific research. We know that any in-house scientific research except land, if you put any capital expenditure, 100% deduction is allowed as per the Income Tax Act, as per section 35. One section called section 35 which talks about scientific research. Suppose a company which is doing in-house scientific research, then 100% of the expenditure incurred, capital expenditure is incurred, is allowed as deduction. So therefore, see, they purchased one machinery. So therefore, depreciation. Now the cost of the machinery is 30,000. For example, see, as per section 35 of section 35 scientific research. Scientific research asset. So when it is scientific research asset, what happens? 100% deduction will be given. 100% deduction in the first year itself. In the first year itself. 100% deduction. That means total cost of the asset will be given as depreciation. So you tell me, first year 14-15 we purchased one plant and machinery, and this plant and machinery is for what? Scientific research. 100% is allowed. So what is the cost of this asset? 30,000. So you deduct 30,000. So therefore, what will be your net profit after depreciation? 70,000. This is called what? Taxable income. Taxable income as far as the income tax is concerned. Taxable income. Now on this I will calculate tax liability. Current year tax liability. So at 30%. So 70,000 into 30%. So it will be 21,000. So I am taking one example, sir. There is company called X Limited. We are computing income tax. Suppose current year 24-25, 1 year is there. Now this year, so what is the net profit before depreciation and tax given? Every year 1 lakh I have taken for your understanding. And see, this year we purchased one asset, scientific research asset. So this scientific research asset, 100% deduction allowed in the first year. So therefore total 30,000 I have given deduction. So my taxable income is 70. On that 30% tax 21,000 came. Can you tell me what happens second year? Second year, will there be any depreciation? No. First year itself entire depreciation is given. So second year my taxable income, suppose 1 lakh. On that 30%, that means 30,000. Third year also same. So 30,000. So this is what? Income Tax Act. So Income Tax Act, this is the position. Now come to P&L account, sir. P&L account. Now very important and interesting. Same years, 23, 20, 24, 25 like that, okay. 24, 25, 25, 26, 26, 27, 3 years. What is my net profit before depreciation and tax? What is my net profit before depreciation and tax, sir? Same, 1 lakh, 1 lakh, 1 lakh. Now you tell me, we purchased one asset na machinery in the year 14-15. 100% deduction is allowed in the Income Tax Act. But as far as the Companies Act is concerned, generally 100% deduction is not allowed. Because Income Tax Act specifically said for scientific research asset, 100% deduction is allowed in the first year, we have given. But when you prepare P&L account, the same asset, you provide depreciation on SLM basis. So depreciation on straight line method on that asset. That means, for example, 30,000 is what? The cost of the asset divided by 3 years life. Now imagine this 3 years life. So you tell me what will be my depreciation for the first year? 10,000. Second year 10,000. Third year 10,000. So understand, Anna, the same asset you purchased, when it comes to Income Tax Act, 100% deduction because of scientific research, section 35, because of the provisions of Income Tax Act. The same asset when it comes to P&L, SLM, over a period of 3 years, 10,000, 10,000, 10,000. Now you see, what will be your net profit before tax? Before tax, it is 90,000, right? 90,000. 90,000. This is your net profit before tax. Now here comes the main point. Once you net profit, then you need to show the tax expenses, right? So from this we need to show the tax expense. First we show what? Current tax. You tell me what is your current tax. That means current year tax liability by following the Income Tax Act. How much came? 21,000. See here, this one, 21. So 90,000 is net profit before tax. But what is our current year tax liability? 21,000 you have to write. Now they say these two are not matching. Why they are not matching? See, you are earning 90,000. You are showing 90,000 in P&L account. Suppose if I apply 30% on 90,000, it will be 30,000. But you are showing only 21,000. Okay. That means your accounting income and tax expenses are not matching. Sir, why they are not matching? Understand. Because see, here you have taken taxable income 70,000 first year. But in P&L you are taking 90,000. That's why they are not matching. So the reason is this. The reason is this, sir. In P&L account you are taking taxable income 70,000. Sorry, in P&L account you are taking 90,000. But as far as the tax is concerned, you are taking only 70,000. So there is a difference of how much? 20,000. Now understand. Sir, this 20,000 difference, why it came? We understood there is a difference. The difference is because of depreciation. Identify. See, because here 30,000 is allowed in the first year itself. But here 10,000 only allowed. So the difference is 20,000. That difference. Sir, in Income Tax Act, entire 30,000 is allowed in the first year, but in accounts, only 10,000 is allowed. Now, this difference is which difference? Timing difference. Why? The total depreciation is 30,000 only, na? Whether you follow Income Tax Act or Companies Act, the total depreciation will not change. 30,000 only. But in income tax, entire 30,000 allowed in the first year itself. But in P&L, you are allowing it over a period of 3 years. That means first year, there is a difference of 20,000. Now, this 20,000 is going to be reversed in the next 2 years. How, sir? See, first year, see, your accounting income is greater than taxable income by 20,000. See, how I am anticipating. Listen to me carefully. What is your accounting income? 90. What is your taxable income? 70. That means you enjoyed the benefit or not enjoyed the benefit? You enjoyed the benefit. Save now. You have taken that 20,000 in the taxable income. There is a deduction of 20,000. That depreciation. Total 30,000 you taken in the first year itself. But in P&L account they have taken only 10,000. So 20,000 benefit of depreciation you have taken. Save now. You saved now. So you need to pay later. That means your taxable income is less than accounting income. See, whenever taxable income is less than accounting income, that means you are paid less tax. So this difference of 20,000 today is going to give you tax expenditure, tax liability in future. How, sir? See, today your accounting income is greater than taxable income by 20,000. Or you can say reverse if you understand very easily. See, your taxable income is less than accounting income in the first year by 20,000. But look at second year. Second year, what is your taxable income? 1 lakh. Third year, 1 lakh. But what about accounting income? 90. So second year, you see, your taxable income is greater than accounting income by how much? 10,000. Third year, taxable income is greater than accounting income by 10,000. So that means first year your taxable income is less than accounting income by 20, but that is reverses in the coming 2 years. Now see, this standard says why accounting income and taxable income is not matching? Because of the timing difference, depreciation. Now, because of this depreciation, there is no matching. So you match it by anticipating this difference of 20,000, and anyway we know that it is going to reverse in the coming years. So you recognize deferred tax asset liability. Now you have to recognize deferred tax asset liability. For simple funda is, today you enjoyed the benefit or not. If you enjoyed the benefit, you take in the deduction, then there will be liability tomorrow. So that means you have taken the benefit today. You have taken 20,000 extra depreciation as per the income tax is concerned. Therefore, on the 20,000, you need to recognize deferred tax liability. Save now, pay later. Therefore, 20,000 into 30%. How much? 66,000 is what? Is deferred tax liability. So therefore, what I will do is, I will identify the difference between accounting income and taxable income. Now I identified the difference between accounting income and taxable income. Now the difference is because of what? Depreciation. Because of depreciation, there is a difference of 20,000. So your taxable income is less than accounting income. That means it is going to give you liability. See, always remember, when taxable income is less than accounting income, in the origination year, it will be a liability. See here, 21. So therefore, you book deferred tax. How much? What is the timing difference? 20,000. 20,000 into 30%? 6,000. Now you see the total. See, I am writing it here. Current tax 21,000 as per the Income Tax Act. Deferred tax 6,000. So total 27,000. Now it is matching. You see, 90,000 into 10%, 30%, 27,000. So therefore, what is my net profit after tax? 90 minus 27,000. 63,000. Now you see, you are matching. So what is the concept we brought to match this? This one. This is the concept we brought to match the accounting income and taxable income, or to match the accounting income with the tax expenses. See, your accounting income is 90. Ideally on 90,000, 30% means you should pay 27,000. But you are showing only 21 because of Income Tax Act. So we identified the reason. We came to know that this reason is timing difference. So therefore, for the timing difference, what will be the tax effect? We anticipated, and we are saying it as deferred tax. Is this asset or liability? Liability. Deferred tax liability. What is the entry for deferred tax liability? See, general liability will be created. So P&L account debtor to deferred tax. 6,000, 6,000. Now see, because of this deferred tax, what happens is, current tax 21, deferred tax 6,000, total 27,000. Now it is matching. These two are matching. 30% if you apply 90,000, it will be 27,000. Now this is the concept of Accounting Standard 22. Identify the difference between accounting income and taxable income. If the difference is a timing difference, on the timing difference, what will be the tax effect? And what will be the tax effect of timing difference? Recognize it in the books so that your accounting income matches with the tax expenses. Sir, you said the tax effect on timing differences we recognized this year. Coming to next year, sir. Next year you tell me, sir, What will be your current tax next year? Current tax. You see the Income Tax Act. What will be the next year tax liability? See this one, 30,000. Second year tax liability 30,000. You write 30,000 here. I am writing here 30,000. Second year 30,000. Now is there matching? Second year no. And see, now the thing is, most important thing is, second year you know that how much is the difference between accounting income and taxable income? Second year. See, second year your taxable income and accounting income. Taxable income 1 lakh, accounting income 90. First year. So first year your taxable income is less than accounting income by 20,000. Now out of this 20,000, next year there is a reversal of 10,000. You see, next year your taxable income is more than accounting income. Observe sir, first year your taxable income is less than accounting income by 20,000. Second year the same thing is reversing. Your taxable income is more than accounting income by 10,000. So therefore first year 20,000 difference is there. Now next year out of 20, 10,000 is reversed. Next year, see, you see the difference. Another 10,000 is reversed. Now that's why this is called timing difference. So first year there is a difference between accounting income and taxable income, 20,000. Now this difference is reverses in the next year. Because next year onwards you take depreciation as per the P&L account, but you don't take it as per the Income Tax Act. So therefore first year there is a difference between accounting income and taxable income, because in income tax entire 30,000 you have taken the depreciation, but in P&L account we have taken only 10,000. Second year you don't take any depreciation in the income tax, but you take depreciation 10,000 as per the P&L account. So therefore the difference of first year is reversing in the coming years. So therefore what I need to do here, see, when there is a difference, deferred tax liability I recognized. Now there is a reversal of 10,000. There is a reversal of 10,000. Now on the 10,000, 10,000 into 30%, 3,000 I need to reverse. 3,000 I need to reverse. Or see, so first year timing difference 6,000 sir. Sir, these taxes we have to deduct sir, please. These are minus, we need to do minus 30. See, minus 6,000 is there now, we need to deduct it from the net profit. See, first year deferred tax liability, deferred tax minus 6,000. Out of this 6,000, how much reversed? Because see, first year there is a difference between accounting income and taxable income, 20,000. So save now, pay later. So you saved now, pay later. Next year 10,000 reversed. That means whatever the tax liability on the 10,000 you paid. Therefore your liability is reversed by 3,000. Out of 6, 3,000 plus reversed. So therefore it will be 27,000. So it will be 63,000. Now it is matching, you see. 90, 27. Third year, same 30,000 tax liability. And third year also 10,000 reverses. So it will be 27,000. So it will be 63,000. So once again sir, I am explaining the concept. Please understand it carefully. See, there is a difference between accounting income and taxable income in the first year. How much? 20,000. And first year your taxable income is less than accounting income. That means you are paying tax on less income, 70,000. Definitely there will be liability in future. Save now, pay later. You are saving. See, you are taking depreciation of 30,000. Whereas in P&L account we are allowing only 10,000. That means 20,000. You are taking depreciation now. Save now. So on this 20,000 there will be liability. So book deferred tax liability now. If I book deferred tax liability today on this 20,000, next year another 10,000 reverses. First year taxable income is less than accounting income. There is a timing difference of 20,000. That has given me deferred tax liability. I recognized. But next year out of this 10,000 is reversed. So therefore whatever the liability I booked, I need to reverse it. Third year another 10,000 I need to reverse it. So therefore, can you tell me what is my deferred tax liability in the first year? 6,000. What is my deferred tax liability in the second year? 3,000. What is my deferred tax liability in the third year? 0. Why? See, in the first year end 6,000 I booked deferred tax liability. Second year out of that 3,000 reverses. Third year another 3,000 reverses. So that means by the end of the third year the balance in deferred tax liability is 0. So that's why this is called what? That's why this is called timing difference. Which difference? Timing difference. Which originates and which is reverses in future. So originates this year but reverses in the coming years. How, sir? Because in the first year your taxable income is less than accounting income. That means you are enjoying the benefit. You are taking benefit. You know this is only temporary. Overall depreciation to be allowed as per the Income Tax Act, as per the Companies Act, same 30,000, 30,000. But only the difference of time has given the difference. See, here you see first year, second year, third year, sir. Income Tax Act you have taken total 30,000 depreciation. Second and third year we are not giving total 30,000. But in P&L we have taken 10,000 first year, 10,000 second year, 10,000 third year. So that means 30,000. So that means, see, the difference is only what? Timing difference. Why I am saying, why the standard uses the timing difference? See, overall same depreciation. Only difference is this. So first year there is a difference of 20,000. Out of the 10,000 reverses in the next year. Another 10,000 reverses in the third year. So the net effect is nil. So what they are saying is, you know this difference between accounting income, taxable income is only timing difference, which is anyway going to reverse. For that effect, the tax effect you anticipate and today recognize, and as and when it reverses, you also reverses it. Suppose I booked a deferred tax deferred tax liability on this 6,000, and out of these 10,000 reverses, so I also reverses 3,000. And next year another 3,000. Now see, what entries we will pass, sir, for this? See, listen. First year, the entries to be passed is, see, first year what we have done, tell me, we recognize deferred tax liability, na? Now every year you observe, sir, there is a matching concept. This one, this one, this one. We have matched it. How matching is possible? Because of deferred tax. We identify why it is not matching. Because of depreciation. We know this is only a timing difference. So therefore, on the timing difference, the effect of timing difference, we book a deferred tax. Now by using this deferred tax, we match the accounting income with its tax expenses. Now see, here if I pass the entries, what entries we will pass here? See, first year end, if you pass an entry, you book a deferred tax liability of 6,000, na? So what is the entry? P&L account debit to deferred tax liability account. Or simply deferred tax. So you write deferred tax account debit to deferred tax liability. First year, what is the deferred tax? 6,000. 6,000. This deferred tax liability, balance sheet we need to show liability. And this deferred tax obviously will go to where? P&L account. That's why see, we debited to P&L account. P&L account debited, na? Deferred tax. So deferred tax account debtor to deferred tax liability, 6,000, 6,000. So in the first year, in the originating year, there is a timing difference. On the timing difference, deferred tax liability arises. And second and third year end, what happens? Tell me. Second year 10,000 reverses, third year 10,000 differences. So whatever the deferred tax liability you booked, you just reverse the entry. That is DTL, account debit to deferred tax. $3,000, $3,000. That's it. So first year end means in our example 31st March 2025. Second year and third year means 31st March 2026 and 27. First year there is a originating year. We create DTL creation. Now next year's reversal of DTL. Whatever deferred tax liability we booked, sir, we just reversed it. So first year there is a DTL creation. Deferred tax liability we created. Second year what happened? We reversed it. Third year another balance reversed. Why? Because see, we observed there is a difference between accounting income and taxable income. And the difference is the timing difference. Sir, what is timing difference? Which originates and which is going to reverse? On that I anticipated the tax effect. That is called deferred tax. If you want, you can analyze very simply, sir. See here. First year what happened is, your taxable income is less than accounting income. See, the moment you see your taxable income is less than accounting income in the origination year, you say deferred tax liability. Next year if you see your taxable income is greater than accounting income, that means first year whatever the difference taxable income is less than accounting income, out of that 10,000 reverses. Next taxable income is less than accounting income. So this DTL is going to reverse. So whatever you book DTL, so next year this DTL will be reverses. So this year you booked a liability. Now next year this is going to reverse. See, as and when the timing difference, see, you anticipated tax on timing difference, right? So as and when this difference is reverses, you also reverse the deferred tax asset or liability. So I think this is the concept of deferred tax. So to put it simply, what is the concept of AS 22, sir? See, simple. This standard says the accounting income and taxes are not matching. Here tax means, here see, in this standard, tax expense means two things. The standard itself said tax expense means two things. One is current tax. Another one is deferred tax. Current tax, deferred tax. One is current tax, another one is deferred tax. What is current tax? See, current tax means tax liability of the current year as per the Income Tax Act provisions. Deferred tax means the timing difference, tax effect of timing differences between accounting income and taxable income. Now see, this deferred tax, see, we know how to arrive current tax. Very simple. We follow provisions of income tax and we calculate liability. Like this, in this problem we have done, see, current year tax, this is 21,000, 30,000, this is current tax. But why they introduced the word deferred tax? Because of the not matching concept. Because of the net profits, accounting income and taxes are not matching. So why they are not matching? Because of the difference between accounting income and taxable income. And these differences are only timing differences. Now for that timing differences, what will be the tax effect? You recognize in the books and match the accounting income with the taxes. So that's why the concept of deferred tax is to ensure that the timing effect of futures will be, anticipated and will be recognized, and with that we will try to match the accounting income with tax expenses. Suppose if the tax effect of timing differences is a permanent difference, it is not a timing difference. The difference, see, as long as the difference is a timing difference, you know this difference is going to, reverse in future. So you are anticipating. Suppose in future liability will come, I will recognize. Asset will come, I will recognize. Sir, what is this deferred tax asset? Liability we can understand, we need to pay. Suppose for example, in this example, we have taken 20,000 depreciation in the first year itself as per the Income Tax Act. Therefore, our taxable income is less than accounting income by 20,000. So therefore, this 20,000 is going to reverse in the coming 2 years. So therefore, our taxable income is more than accounting income. So we end up in paying this liability. So we recognize deferred tax liability. What is deferred tax asset? Savings in tax. See, this year you bear the burden. You paid the tax. So there will be savings in future. So whenever there is a savings in future, you book a deferred tax asset. Same manner to match the tax expenses. income, I mean to match the accounting income and its taxes. And these are the entries we will pass. Deferred tax to deferred tax liability. And you reversed it whenever the timing difference is reverses. So like this, every year we need to anticipate what is the difference between accounting income and taxable income. If the difference is permanent, ignore. If the difference is timing, anticipate tax effect of timing difference and book this as deferred tax, either liability or asset. When liability is when you save now, I mean your taxable income is less than accounting income. You are enjoying the benefit now as per the Income Tax Act. That means there will be liability tomorrow. So therefore, deferred tax liability. Suppose if you are enjoying the benefit now, if you are not enjoying the benefit now, you are paying the tax on that. Tomorrow there will be savings. So deferred tax asset. So you book either a deferred tax asset or a deferred tax liability. Suppose if there is a deferred tax asset, what is the entry? Simple, asset will be debited. Deferred tax asset account data to deferred tax, and this deferred tax will be transferred to P&L account. And next year, when the timing difference is reverses, you reverse it. Reversal of DTA. Now see here, we discussed the objective now itself. I explained the entire concept of deferred tax. So this standard prescribes accounting treatment of taxes on income and follows the concept of what? Matching expenses against revenue. So the concept of matching is more peculiar in cases of income taxes, since in number of cases the taxable income may be significantly different from the income reported in the financial statements. Correct? Because what we report in P&L account, on what basis you are paying tax, they are entirely different. Due to the differences in treatment of certain items under tax laws and the way it is reflected in accounts. See, in income tax we have different treatment for different items, but in accounts we follow different treatment. So there is a difference. That difference we identify, and if the difference is only a timing difference, we anticipate the tax effect of the timing difference now itself. That is the standard. So this standard is all about how to provide accounting treatment for such a difference, that the difference between accounting income and taxable income. And I told you that the difference can be two types. What is that? Timing difference, permanent difference. And we recognize, deferred tax only for timing difference. Because if it is a permanent difference, there can't be any effect of tax in future. So therefore, we are not bothered about permanent difference. Sir, which difference is timing, which difference is permanent? For that, you need to understand the provisions of Income Tax Act. And what is the scope of this standard, sir? So this standard is applied in accounting for taxes on income. Taxes on income includes all domestic and foreign taxes which are based on taxable income. Again, so simply whatever the taxes we are paying, either domestic taxes or foreign taxes, everything is covered in AS 22. This standard does not specify when or how an enterprise should account for taxes that are payable on distribution of dividend. That means, see, whenever we are distributing any dividend, we need to pay tax. Of course, this is not relevant now because now companies are not required to pay any dividend distribution tax. The shareholder has to pay the tax. So I think this point now become irrelevant. So you can ignore this point. Now some definitions, important definitions I told you. Accounting income means what? Accounting income means net profit as per P&L account. Net profit as per P&L account. See, net profit or loss for the period reported in the statement of P&L. What is taxable income? Taxable income means the income which is arrived by following the provisions of Income Tax Act, and based on that you pay the tax of the current year, right? So taxable income is the amount of income determined in accordance with tax laws. So understand, that's why in the beginning itself I started with accounting income, taxable income. Taxable income means which is calculated as per tax laws and on which you compute the tax liability of the current year. And tax expense, important, sir. So in the example itself, see, when I was solving this, intentionally I have written, sir, you see, if you observe or not, see here, what I have written here is tax expense. What is this tax expenses? Because this is exactly the word which is used by the standard. Tax expense means both current tax, deferred tax. These two, current tax as well as deferred tax. That is what they are saying. Aggregate of current plus deferred tax. What is current tax? This year tax liability you calculate as per Income Tax Act. Amount of income tax determined to be payable in respect of the taxable income for the period. What is deferred tax? Deferred tax is the tax effect of what? Timing differences. Tax effect. What is the tax effect of this timing difference now? Today there is a difference. That difference tomorrow will gone. Now on that difference, what will be the tax effect? That is deferred tax. Because that's why they are not matching now. What they are matching? In P&L account, accounting income and tax liability is not matching. Why they are not matching? Because of these timing differences. Now these differences today is there. Tomorrow they will reverse. So therefore, what will be the tax effect? You recognize now. So what is the timing difference? See, the differences between accounting income and taxable income for a period that originate in one period and are capable of reversal in one or more subsequent periods. Originated and which is capable of being reversal. So that's why deferred tax is calculated only on which differences? Timing differences. Sir, suppose for example, permanent difference. What is permanent difference? The difference between taxable income and accounting income for a period that originate in one period do not reverse subsequently. Do not reverse subsequently. So they should be ignored. So please understand, we need to recognize deferred taxes, either asset or liability, only for timing differences. For example, see, fines and penalties. I told this as an example also. Suppose you paid penalty. Will it be allowed in P&L account? Yes. Penalty will be debited to P&L account. Normal accounting loss we will allow. But is penalties paid for violation of law allowed as per Income Tax Act? No. That means the difference between accounting income and taxable income is penalty, and it is a permanent difference which is not going to reverse in future. Agriculture income. Sir, agriculture income, we know as per the Income Tax Act it is completely exempted. But in accounts we will consider that as an income now. So the difference is there. Is this difference is going to reverse? No. Agriculture income is exempt. Exempt means exempt. So it is not going to be taxed again. Next, expenses which are disallowed forever as per the Income Tax Act. Section 40A of Income Tax Act. So some exemptions, expenses which are disallowed forever. For example, corporate social responsibility expenses you incurred, disallowed forever. Any income tax expenses, tax on income tax, disallowed. Any penalties paid, disallowed. Any income taxes paid, disallowed. And donations which is not covered in 80G. So any donations which is not covered in section 80G, disallowed forever. So these are some of the differences between accounting income and taxable income. As per the Income Tax Act, they are not allowed. So these are called permanent differences. See, this is only a sample list. See, that's why I said, when you want to learn Accounting Standard 22, please read PCBP chapter at least. Because you will understand what I am talking, what the content is all about. Because you can able to relate what the difference is. Otherwise, it will be very difficult. And what is the permanent difference, timing difference? Examples, see here. So many examples you can say. 43B expenses. See, in income tax, there is a section called 43B, which says certain payments will be allowed only when you pay. But in accounts, we follow mercantile, accrual basis. But in income tax state, some expenses we allow only on payment basis. For example, interest on loan, I told. Interest on loan we allow only when you pay. On payment basis, we allow. Another one is gratuity. For example, you paid gratuity to the employee. Only when you pay, we will allow. Suppose you created a provision for gratuity, we don't allow. In income tax, suppose you created a provision for gratuity. Of course, you debit to P&L account. In accounts, we allow. We debit to P&L account. But income tax, we don't allow. So that means there is a timing difference. You create a provision this year. It is allowed. As for the accounts, we debit to P&L. But income tax, it is not allowed. When you pay, it is allowed. 43B. Any taxes, duties, cess, they may be recognized in the statement of P&L on accrual basis, but it is allowed for tax purpose only in the payment year, payment basis. Similarly, any payments to non-residents accrued in the statement of P&L on mercantile basis, but disallowed for tax purposes on 40AI. See, suppose for example, you make any payment to non-resident without deduction of tax, TDS. So 40AI says 100% of the expenditure will be disallowed. For example, you paid some amount, suppose some contract payment to the non-resident without deduction of TDS. Now Income Tax Act says 100% disallowed. Then it is, which year it is allowed, sir? The year in which you pay, it is allowed. So that means, see, the moment you incur an expenses, you debit to P&L. But in Income Tax Act, no, we don't allow. You have not deducted TDS, you have not paid it. So in the year of payment, we allow. So there is a difference between accounting income and taxable income. That difference is timing difference. See, Income Tax Act not saying that if you don't deduct tax, we don't allow this year. In the year of payment, we allow. So that means the benefit is deferred. That's why this is timing difference. Whatever provision you book, whatever expenses you incurred, you recognize in P&L account. So there is no problem in P&L account. Whatever you want, you can recognize in P&L account. Suppose, for example, if any expenses, unnecessary expenditure you are booking or illegal expenditure you are booking, that is the job of the auditor. He will look after, as far as the P&L account is concerned. But Income Tax Act, there is a separate act which clearly says which expenses to be allowed, which are not allowed, when to be allowed, whether they will be allowed at a time or over a period of time. Similarly, one more section called 40AIA, when you make any payment to residents in respect of which tax you need to deduct, but you have not deducted, 30% of the amount will be disallowed. But in accounts, we completely debit to P&L account, but in income tax, 30% is allowed. When it will allowed? When you pay, allowed. Similarly, one more section called 40A3, cash payments. Suppose if you make aggregate payment to a person in a single day exceeding 10,000 in cash, completely 100% is allowed. So this is a permanent difference. For example, a company paid salary to a person, Mr. X. Suppose 15,000 they paid in cash. This is disallowed as per 40A3. But is this allowed as per the accounts? Yes, in accounts, salary expenses we debit. We don't see whether we paid in cash other than cash. But in income tax, they say when you pay in cash, we don't allow. So this difference is what? Permanent difference. It is not going to reverse. See, expenses amortized for tax purpose over a period of years but are allowed in the account. See, some more differences, timing differences. Sometimes what happens is, P&L accounts we allow in the first year itself. But in income tax, we allow it over a period of time. Best example is 35D. Section 35D, preliminary expenses. I told now preliminary expenses will be allowed over a period of 5 years in income tax. But here, we allow entire expenses, we debit to P&L account. So there is a difference between accounting income and taxable income. And that difference is going to reverse because Income Tax Act is not saying that we are not going to allow. They are saying we are going to allow, but we will defer it for 5 years. So that means current year there is a difference. But this difference is only a timing difference, temporary difference, which is going to reverse. So therefore, what will be the tax effect? You anticipate now. Now, because of that, there is no matching of accounting income and tax expenses. So identify the difference. If the difference is timing difference, you recognize it in the books. Similarly, any expenses incurred for amalgamation under section 35DD, I think amalgamation expenses, they will allow over a period of 5 years. So all these differences, sir, difference in depreciation, methods of depreciation. See, depreciation, definitely there is a timing difference between accounting income and taxable income. So these differences will understand only when you read the provisions of Income Tax Act. I don't think so. You are not going to reverse. You are not going to remember anything. The only 2 or 3 examples quite frequently come is depreciation, one example, and another one is that amortization expenses, interest expenses. So basics only will come. So now what we do is, we'll try to solve some questions relating to deferred tax. See, since we discussed the concept of deferred tax, we'll try to solve some questions. And after that, there are some more concepts relating to deferred tax. I'm going to explain them.